Happy Saturday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. I'm filming this away from where I normally film. I'm currently in Seoul, South Korea, speaking to some experts about the economy and their recent trade deal. Because of this, I ask that you forgive the informality of this filming environment and my attire. Now, there are some big developments we need to cover, so let's jump in. And we need to begin in North America. Stocks tumbled on Friday, yesterday, to open August trading on a grim note, as investors digested US President Donald Trump's sweeping new tariff measures alongside fresh evidence of a cooling labor market. The combination of heightened trade tensions and signs of economic weakness sent major indexes to their steepest losses in months and intensified calls for the Federal Reserve to act. Trump unveiled a revised slate of tariffs late Thursday, raising the average US levy on imports to 15.2% from 13.3%. That marks a dramatic jump from the 2.3% average rate in 2024 before Trump took office, and pushes US tariffs to their highest sustained level since the World War II era. While the baseline 10% rate for many trading partners remained unchanged from the duties imposed in April, some nations were hit hard. Canada, one of the US's largest trading partners, saw tariffs on selected goods raised to 35% from 25%, a move likely to inject fresh strain into cross-border relations. Switzerland faced a steep hike to 39%, while New Zealand, Taiwan, and South Africa were also targeted with higher duties. Roughly 40 countries now face the 15% tariff rate, with about a dozen subjected to even larger increases. The measures, signed just hours before Trump's self-imposed August 1st deadline, are set to take effect after midnight on the 7th of August to allow US Customs and Border Protection time to implement the changes. Additional tariffs on pharmaceuticals, semiconductors, critical minerals, and other industrial goods are expected in the coming weeks, leaving businesses and markets bracing for continued uncertainty. The rollout has come after several high-profile trade deals with major trade partners like Japan, the EU, and the UK. The market fallout was swift. In US trading, the Dow Jones Industrial Average plunged 542 points, or 1.23%, in its worst day since mid-June. Adding to the sell-off was a poor July employment report that underlined the economy's softening momentum. Non-farm payrolls rose by just 73,000, far below the 100,000 forecast by economists. More troubling were major downward revisions to previous months. June job gains were cut to 14,000 from 147,000, and May was revised to 19,000 from 125,000. The revisions slashed the 3-month average payroll increase from 150,000 to just 35,000, signaling the labor market has been slowing for some time. The unemployment rate ticked up to 4.2%, in line with projections. The report also showed signs of growing inequality, a political sensitivity in the United States. The black unemployment rate climbed to 7.2%, its highest level since October 2021, while manufacturing employment dropped for the third straight month to its lowest level in over 3 years. The only significant job gains came from private education and health services, which added 79,000 positions. Treasury markets rallied as traders dramatically increased bets on a September rate cut from the Federal Reserve. Trump's tariff announcement ends months of speculation over the reciprocal tariffs, first floated in April as a central pillar of his trade agenda. The president twice delayed implementing the measures, initially after markets reacted sharply, and later to allow foreign governments to negotiate. In the end, many key economies, including the EU, Japan, and South Korea, which we'll cover shortly, accepted 15% duties, while dropping most of their duties on US goods to near zero, while Mexico received a 90-day pause to secure better terms. China remains a wild card. Its temporary tariff truce with the United States expires on the 12th of August, though officials signaled after recent talks in Stockholm that an extension is likely. Meanwhile, rules governing transshipped goods, which could face penalties of 40% or more, are still being drafted, adding another layer of uncertainty for global supply chains. Trump has long argued that higher tariffs will revive US manufacturing and reduce trade deficits, while critics warn they will raise costs for consumers and exacerbate inflationary pressures. There is also a geopolitical consideration in bringing strategic supply chains closer to home and reforming the trade system away from China. Next up, we move across the Atlantic to Europe. British business leaders are more pessimistic about the UK economy than at any point since the Brexit referendum, COVID-19 pandemic, or Liz Truss's mini-budget, according to a new poll by the Institute of Directors, IOD. The July survey found over 80% of executives were very or quite pessimistic about the year ahead, driving the IOD's Economic Confidence Index to a record low of -72. Concerns over rising costs, potentially potential new taxes in the autumn budget and uncertainty around tariffs have led many firms to freeze investment and hiring plans. Anna Leach, the IOD's chief economist, warned that speculation over tax increases has created a, quote, damaging climate for business, end quote, and urged the government to, quote, quash rumours of further tax rises, end quote, while accelerating deregulation. The grim findings contrast with the International Monetary Fund's forecast projecting UK GDP growth of 1.2% this year and 1.4% in 2026, outperforming many European peers but lagging behind the US and Canada. However, the IOD poll adds to evidence of mounting caution among both businesses and consumers amid a weakening jobs market and persistent cost pressures. Other business groups have echoed the concerns. The British Retail Consortium survey showed 9 out of 10 finance directors listed taxes and regulatory burdens as top worries. Political reaction was swift, with Conservative shadow ministers accusing Labour of fueling economic uncertainty, while Chancellor Rachel Reeves pointed to a separate Lloyds Bank barometer showing the highest business confidence since 2015. Despite some more positive surveys, the IOD's findings underscore deep unease. Fewer than 1 in 10 executives expect current government policies to boost growth, while expectations for revenue and investment are at their weakest level since 2020. An overwhelming majority of companies also anticipate further cost increases in the year ahead. Now, we have one more development to cover, but just quickly, if you want to be on top of the most up-to-date analysis on the biggest developments from the world's most important markets, consider subscribing to Market Update. Hit the bell notification icon and you will be. And if you're getting some value from today's episode, don't forget to hit the like button. And finally for today, we move to Asia. President Donald Trump's Liberation Day 2.0 tariffs are set to take effect on the 7th of August, capping months of uncertainty for global markets, including Southeast Asia. Like we said before, the sweeping changes push US duties to the highest level since World War II, reshaping trade dynamics across the region. Singapore emerged among the least affected, facing a baseline 10% tariff, far lower than the 19% levied on Thailand, Malaysia, Indonesia, and the Philippines. Prime Minister Lawrence Wong called the rate one the city-state can, quote, live with, end quote, though he reiterated his preference for zero tariffs. Still, the jump is stark compared to the roughly 2% average duty before Trump took office, once again showing the magnitude of the policy shift. Not all nations fared as well, however. Laos and Myanmar were hit with steep 40% tariffs despite their smaller economies. The US imported more than $800 million in goods from Laos last year, primarily apparel and furniture, while Myanmar maintained $734 million in trade despite ongoing US sanctions. Analysts warned the sudden spike could inflict serious damage on both countries' fragile economies. Meanwhile, in East Asia, this week the US and South Korea struck a trade deal imposing a 15% tariff on Korean imports, including automobiles, while establishing a $350 billion South Korean investment fund targeting American energy and shipbuilding industries. The agreement, unveiled by President Donald Trump on Thursday and confirmed by Seoul, spares South Korea from a looming 25% tariff just before the deadline, securing relief for one of the US's largest suppliers of cars, smartphones, and machinery. Under the deal, South Korea's auto exports, a cornerstone of its economy, will face the lower 15% tariff, aligning with the rate granted to Japan in a similar pact last week. The agreement also includes Seoul's commitment to purchase $100 billion in US liquefied natural gas and energy products over the next 3.5 years, strengthening Washington's push to boost American energy exports. President Lee's young administration scrambled to finalize the pact amid domestic political turbulence, with negotiators successfully shielding sensitive sectors such as beef and rice from further US market access demands. Quote, "This removes a major source of uncertainty for Korean exporters and puts us on level ground with our competitors," end quote, Lee said, calling the deal a crucial step to bolster Korean firms' presence in the United States. Markets reacted cautiously. Seoul's Kospi index dropped 0.3% after early gains evaporated, while the won, the Korean currency, weakened following an initial bounce. Shares in Hanwha Ocean Co. surged on news of the shipbuilding partnership, though auto giants Hyundai and Kia fell as the tariff rate landed above their preferred 12.5%. Analysts say the agreement offers short-term relief but leaves strategic questions unanswered, including tariffs on key exports like chips and batteries. Trump said South Korean President Lee will visit Washington in the coming weeks to cement the deal, which places Korea alongside Japan at the forefront of the US's evolving global trade order reset. Okay, that is today's episode of Market Update, coming to you from South Korea. So I'm glad we could finish on that South Korean development. Thank you everyone for watching. Have a wonderful weekend, have a restful weekend, and I will see you for a new week of developments on Monday.